Welcome to the latest video on the Casterbridge Managed Portfolios. It has certainly been a volatile couple of weeks in politics and markets, so let's jump straight in. We rebalanced or updated all managed portfolios last week to take advantage of the recent panic to add more risk into portfolios. We've had a few advisors ask about our timing, given that we had postponed our scheduled rebalance from the middle of March until last week. How do we decide when to trade at times like this, particularly when it seems we could have traded very close to the bottom in equity markets? So I thought I'd start by talking about this, as it might be a useful insight into some of the things we consider when managing portfolios. It's a combination of factors. If we take a step back, for much of 2024, we had been warning about the growing exuberance in US markets and the technology sector in particular. We were underweight these markets and said repeatedly that we were not going to buy more just because everyone else was. Valuations were becoming too stretched and markets are becoming priced for perfection. We sensed that some advisors were perhaps a little frustrated that we weren't joining the party, as our performance was good but not at the top of the tables. We said that we would increase exposure, but when valuations were more attractive, so at a time of our choosing, not because of external pressure. So with US markets priced for perfection and most investors all in on the tech and AI trade, we just needed to wait patiently. Then at the end of January, we had news from Chinese AI company DeepSeek, which signaled big competition for US tech companies. In February, the US Federal Reserve signaled rate cuts would not be as significant as investors were hoping. And then in March, Germany proposed a change in rules which would loosen their fiscal straitjacket and so boost economic growth in both Germany and the wider European economy. So putting this together, we had bad news for US dominance and better news for European growth. And with US markets being expensive and UK and European markets cheap, we had the trigger for a major shift away from the US into other markets. As a result, our portfolios were positioned for this, and this pushed our portfolios towards the top of the performance tables by the end of Q1. But with markets now fragile and with Trump about to make announcements on tariffs, we had decided to wait a little longer in anticipation of further volatility, and this duly arrived 10 days ago, also on so-called Liberation Day. As we said several months ago, before the US election, Trump is a businessman first and foremost. He used tariffs in his first term, and he's been talking about tariffs for the last few months. So we could be fairly confident that Trump would start off hard and then backtrack as part of his negotiations. We shouldn't have been surprised by the way he's done this, yet markets appear not to have focused on this, and that's why they got spooked. There are many indicators and tools we use when deciding when to trade, but on this occasion the main trigger for us to press the button was the sheer panic in the markets and media. Warren Buffett once said that it's wise for investors to be fearful when others are greedy and to be greedy only when others are fearful. So when so many were panicking, and when this was the top story in all the news bulletins, that was the trigger for us to act. The team here have seen this sort of thing time and time again. Human psychology doesn't change. There will always be greed and fear, and we use this to our clients' advantage. So what did we do in this rebalance or this update to our portfolios? Nothing too aggressive. Overall asset allocation is unchanged, with an average risk or balanced portfolio remaining close to 60% equities, 20% alternatives, and 20% bonds. It's mainly about fine-tuning our equities to add to those high growth areas which had been the hardest hit over recent weeks. So we're taking advantage of the recent fall in US equities and the US dollar to increase US equities by reducing UK equities, where we continue to see a challenging outlook for the UK economy. And then within the US, we're making 3 changes. We're adding exposure to artificial intelligence. We're switching our main value fund into a new value fund where we expect stronger performance and where we can access the founder share class, which means lower costs. And we're introducing a new small cap fund for medium and higher risk portfolios. And then within the bond allocation, for lower and medium risk portfolios, we're reducing government bonds and introducing a new index-linked bond fund as this should provide better returns and protection with the higher inflation we're expecting. Looking forward, and the reason we're not adding risk more aggressively, there are still a lot of uncertainties to navigate, over the coming weeks and months, such as the ongoing negotiations between the US and China on their tariffs, the impact of all these various tariffs on growth and inflation. Closer to home, what is the UK government going to do to reinvigorate the economy? And, the direction of EU politically and how the Ukraine conflict is going to be brought to an end. So we feel comfortable to take advantage of the current panic in markets to add risk, but given these ongoing uncertainties and the increased risk of recession, we're adding these risks gradually at this stage. One key point which I would repeat, given the current uncertain environment, and where Casterbridge, I believe remains somewhat different to other providers, is that our portfolios remain well diversified. We've highlighted on numerous occasions over the last 3 to 4 years that we feel that bonds are no longer low risk, and the proof is very much in the pudding in that they have fallen by about a quarter over this period with extreme volatility at times, behaving more like equities than the way bonds should behave. So there is still so much uncertainty with bonds, whether it's China selling, ballooning government debts or soaring interest payments. You might be getting around 4% in interest, but you can have little confidence in where prices will be over the next year or so. And this is why we're maintaining a relatively low weight compared to peers and prefer a selection of alternative or absolute return funds, which should continue to produce steady positive returns in nearly all market environments. And then this helps keeps the overall volatility of portfolios low while still meeting the client's long-term objectives. I hope this was a useful update. Until next time, thank you.